All right, welcome back to the Damp Spring Roundtable. I'm Ben, and today I'm joined by Andy, Jimmy, and Nick. In this episode, we're going to start with the war in Iran, now 3 weeks in, and what it means for energy markets, bonds, and the macro picture. Then we'll cover tariffs, the dollar, and how the FOMC has made its call. And then we'll close with tech CapEx. Timestamps are below. Let's get into it. All right, so my first question is, the Brent hit 120 and then pulled back to 107. The IEA release buys roughly 20 days of a full straight closure. How do you trade the next 20 days if this doesn't resolve?
Yeah, so it's the question is, how does it not resolve? I think when you're thinking about what's happening in Iran, you're really trading headline to headline, and I think it's very difficult to actually have an edge on that. For me, I'm just thinking about whether I want to have less or more commodities in my long-term portfolio and what the prices of the commodities, oil in particular, is doing to the economy, et cetera. But gosh, I don't have a clue in terms of how to trade the price of oil right now, particularly the front contracts.
Yeah, I think what like obviously I focus more on CL. They move together, but obviously we're going to have like a big divergence with Brent, and if this continues for a long time, you'll need to watch that spread. But I think $100, as long as we stay under 100, I think it's going to show a relaxing of the environment. It's not that big of a deal, but if this war continues for an extended period of time, we start seeing energy infrastructure being attacked, like Trump warned about in the next 48 hours. You see him blow up a nuclear plant. I mean, there's so many things that can happen that $100 will seem cheap. Like you said, there's probably no edge in guessing, but we can kind of do scenario analysis. And when we talk about inflation impulses, you got to really think about like who's going to be hurt by this. So this isn't, I'm not super rich or anything, but gas could double from here and it affects me none. You know what I mean? Like, it's not a big deal to me. It's not, and that's why we live in a K-shaped economy. So it's going to hurt the bottom quantiles. And so that's really the thing you have to look at. And if they start to get hurt, and we're thinking about the Fed possibly hiking rates, which I don't think they're going to, but that's what the SOFR market is pricing, essentially half of a hike. It's something that would probably be very bad for the economy, bad for asset prices, bad for risk. And so, like, pretty much my suggestion is just set your alarms on CL. If it starts trading over 100, get rid of the risk. If it starts trading under 90, there's probably something floating out there that's going to be good. When it comes to the time frame as a whole, this war, you can't really put a time frame on it, but let's say if this war is going on 3 months from now, then it's a serious problem. But if it can solve itself in a few months, then I think it's about as good as it could go. You know what I mean? Like, I mean, before this attack, Iran was considered to be like not Hezbollah, not these smaller players. It was the big boy in the room, and they sort of caught them off guard with just how aggressive it's been. So do we know what's going to happen in the war? I don't think so at all. I think it's impossible to guess. But when it comes to the oil price, I think it's either 60 or 150.
Plus, this time around, we have a much more cagey administration as we're proceeding. Even if things aren't going well, this isn't wrapped up in the next 2-3 weeks, it's not going to be a situation like we're used to, where it's just like, oh, Jesus Christ, we're going to 150. This isn't going well. This seems like it, we're also going to be getting constant feedback from Trump and the administration, whether it's valid or not, but jawboning it down, and maybe even trading it too. So, if things do keep going in the same pace as they are going now, which is like, we don't really see an end in sight. We're not, they deteriorate slowly. It'll be a rally, but it's going to be herky jerky. It's not going to be that you can just buy it and forget about it. This is, we're going straight up. This is a little bit different than in times past. And I remember I remember the first time crude ever went over 50. And I remember Ken Hebner, everyone was freaking out. Remember the Mad Bomber from Boston was like, everybody calm down. It's $100 billion tax on the American consumer. They can deal with it. They deal with a lot of stuff, you know. So, and I remember at the time, everyone was freaking out, like, oh, this is the death knell to the economy. That's it. But but the consumer did weather that first pump, and they do weather these. They can weather these energy spikes temporarily or for short periods of time, you know. What, and I should correct that, longer periods of time than you would actually imagine, before you see massive deterioration. But and which goes back to my first point, where I just don't see this administration letting this situation spiral out of hands, where we see the same type of move that we saw last Sunday night. That was, you know, that was a big reaction. First time Strait of Hormuz, we've been getting threats that they're going to shut the straits for years, decades, you know. We actually saw it. We saw the spike up, but even the price action after that during the week shows you that it's not easy just to get long this stuff. You know, there's pain on the downside too. A little bit different of a situation trading it.
All right. So you don't feel as if do you think the 20-day strategic reserve buffer is enough to stabilize oil prices in the meantime? Like, do you think they can?
Well,
I think so there's a couple of things going on, right? There's an actual blockade, effective blockade, which is preventing roughly 20 million barrels of freely moving oil per day. That's being corrected by a combination of diverting oil through Saudi and intervention. The intervention, that does not have an infinite capacity. And so the intervention can keep things from escalating in terms of oil prices for a few weeks, months. And then it's over. And then you have to deal with the actual root problem. So to answer your question it's enough to make it not go to 150. If you literally took 10 million barrels off the market per day, you're talking, and you cannot impact them, you're talking about a significantly higher oil price. But again, I don't want to drill into this very narrow topic of trading short-term oil and counting the barrels. The big thing is the progress of the war and whether the path will significantly change. And this is why it's a headline problem. Friday after the close, we get a headline that Trump wants to end the war quick. One day later, we get an ultimatum that 48 hours from now, we're going to destroy massive infrastructure. That just tells you that even the administration, who's partly manipulating us, partly coming to their own decisions, partly dealing with other forces, the Israelis, the Iranis, the Gulf states, and the globe, dealing with all those things and making changes on the wire. The big thing for me is, while it seems reasonable to expect de-escalation, I'm not sure how that helps you. Like, we all expect de-escalation at some point, and so the market already expects de-escalation. And so to me, the headlines are noise, and the end state to me is more important, and the final end state, like when you look back over this period of time, what was accomplished? And so when I think about that, the first thing I think about is what would be a win. And to me, a win would be Iran no longer having an influence in the globe. That would be a win for the United States. How would you do that? There are lots of tactics. Destroy the Navy, destroy the Army, destroy the ability to make missiles, destroy missile capabilities broadly, prevent any nuclear development whatsoever. Those are clear, and then potentially change the regime. You know, that would be a win. I don't see any chance that any of those things occur without significantly more kinetic warfare. And so I see the path. By the way, I also see the path to that thing, but it's going to take a lot of kinetic warfare to get there. And so the alternative is a temporary de-escalation, which that can be unilateral, or that could be bilateral or multilateral. But it's going to have to, in this circumstance, it's going to have to be multilateral. It's going to have to involve Israel. It's going to have to involve the United States. And it's going to have to involve the Gulf states. And they're on the same team. And so to get them and the Iranis on the same path, to me, just represents a low probability outcome, unless the U.S. does it unilaterally. And so when I think about the U.S. doing this, short of victory, doing a unilateral de-escalation, the only way I see them have any reason to do that at all is, and I think Wall Street heavily overestimates its own self-importance on this topic, but the only way I could see that is if Trump's so-called tacos, which deals with needs to correct a major market correction. Now, stocks are down 7% from the highs, bonds are up a little bit in terms of yield, dollar's fine, oil's not crazy. There's no reason to taco. So I think we just keep going. I think it just keeps going. And so that's sort of my outlook. And I'm optimistic about the end destination.
Yeah, I think that's a good overview. I guess the thing that like I would focus on is the time frame has been so small. You know what I mean? Like we're talking like 3 weeks, and obviously us being in markets, we're hyper focused on asset prices, and so like obviously if this thing drags on 2 months more or something, right? Their asset prices are likely going much lower, but like in the grand scheme of life, I mean, 3 weeks into a war, it's very difficult to decide anything, and and the fact that this much damage has been done, and then you add to it, you have Saudi Arabia, you have Qatar now who's very angry, and they do want some form of de-escalation. And so it's like if they join the war, like how aggressive does it get? So I mean, I think in the short term we could have a ultra ramp in aggression. We could have that like a peak, like a very sharp peak upwards where people join the war and stuff like that. But as far as that concern goes, I think it's the time to be defensive in your asset allocations, but at the same time, I think that buying U.S. companies that are sort of insulated from this, and that's why you can see like kind of a rotation back into tech, rotation back into services, things that aren't going to be as affected by the war. I think that you could find value there in this sell-off if it does continue. So that's where I would be looking. As far as war goes, obviously the loss of life. We don't want to. But just from a sheer asset perspective, I think that if you can sort of get the baby with the bathwater trades, I think that's what we got to be looking for.
Overall, I think this this issue in the Middle East has brought the equity markets into probably a larger correction. Now we're starting to drop below, drop back down to no lows, 6-month lows type of areas on the charts, and I think that. I have no edge in determining whether we're winning this war or not winning this war. I try my best sources out there, guys I've been following for a decade on, geopolitical, like military stuff and even they are at odds with each other. We have air superiority, yeah, but we this is happening, it seems like a complete hornet's nest, but either way, I just don't see it resolving anytime soon. And I think that's what equity markets are kind of telling us too. Just the uncertainty surrounding this entire situation is just going to be negative on markets. It's going to be negative on equities. And yeah, we want to see a taco. Equities are prepared for, they react quickly when they get a bullshit headline like, we're almost, even like this week, it was maybe the second or third one of Trump saying, yeah, it's almost over. It's almost over. Usually markets start kind of getting sick of the same rhetoric, especially when it's not producing any decent
Follow through.
Through, which it wasn't. I just, I think we're gonna run into the next couple of weeks anyways, or this week, I should say. Let's go this week, because without a hard taco. But I think
This is
I think
we try to be more broad here, but I think it's a good opportunity for us. We only meet once a month. It's a good opportunity for us to be pretty short-term thinking right here.
yeah,
If you're going to add value, if you're going to be listening to us and you want to get any value at all, this is an important time. So
right.
it's important that we give a fair amount of focus on not long-term predictions, but what is in front of us.
And that's where I'm getting at. I just feel
The first thing I'm interested in on that is last week we had every central bank significantly more hawkish than they would have been prior to the war. Some were less hawkish than expectations, like the ECB. Some thread the needle pretty well, like the U.S. Fed and maybe Japan. And then some shat the bed, like the U.K. But broadly, a month ago, we were only talking about pauses and eases. And now we're only talking about pauses and hikes. And I think that's a big deal.
For sure. And then, I mean, Australia already hiked, so there you got like kind of a divergence over there starting. Then obviously, like you said, the Bank of England came out and just absolutely demolished their stir markets, and that bled into our markets. And now we have a quarter point or like a half point hike in September built into the stir curve.
So, given that, it seems important to think about where the U.S. rate path is going. So what are you guys thinking on the rate path? I mean, just from a factual standpoint, we're essentially we're actually pricing a hike in the next 3 meetings, which is presumably Powell's last 2 meetings at least. That seems unlikely to me, but that's what the pricing is. We're priced for no hike, no cuts at all any longer.
I think this is like the final fuck you by Powell, and he's got like a runway to do it, and Trump's handed him this runway, and he's going to take it. I think it's ridiculous to think that there's any long game in this, and this is definitely off the. I feel like this is like a political pushback to a guy that's been really, really tough on the Fed and Powell's administration, and I think it's, he telegraphed it. I thought, we kind of saw this coming. He's been, they've been going back and forth for a year now. And I honestly feel like this is a little bit of political retribution, for the Lisa Cook situation. I think for the investigation that's still ongoing. And, I'm still not really sure what that's about, where the actual issue is with, the indictment, right now.
The construction.
Yeah.
But, it sounds
so
like, do you think he might hike?
No, I don't. I think he's just stalling at a time when in reality, he could probably be a little more dovish. But he's going to be hawkish into it. He's going to,
He certainly poo-pooed we had a very cold labor print. I mean, negative.
Right, and he poo-pooed that.
But
I mean, for the last 4 years, we've been watching them react exactly opposite of this, So how can I not say this is political? Or it's not even political. It's personal. This is a personal thing. On top of that, I think
Go ahead.
I think that positioning couldn't have been worse for this. When I look at these markets, how they're reacting right now, I'm just seeing puking across the curve from the fronts, from the very front SOFR on back, just barfing like.
Right. And the European position, UK positioning in particular, everyone said the UK's economy is the worst. They need to cut the most. Everyone was long that market and short and against the US. And
Right.
they're just destroyed.
Murdered. And this is, and I think what's really happening, I think what's going to happen is that we're going to get this washout here. I think it's a tremendous opportunity to fade this move because
You didn't stir.
yeah, absolutely. And you know what? I have been on the wrong side of stir back in the 90s. This is what happens. You get too many guys on one side of the boat. These are the pukes that you see, and then they go against any type of conventional wisdom or logical thinking. The moves extend, and then and that's part of the puke. But those are fades. This is a fade. This is not help is on the way. Warsh is coming in. He's going to completely remake the Fed. The entire rhetoric is going to be flipped around to, the labor market's soft and there's always cover for these guys' bullshit excuses on whether or not to do anything. There's always cover, we can always talk both sides of the market and they can too. And right now they're pressing Trump. There's an end game to that. Help, I honestly feel like help is on the way, and this will be radically different in 3 to 6 months from now. Radically.
Yeah, and I think that you could set up two SOFR trades essentially here. One is to fade now. So you're fading, the cuts in September, you're fading the cuts in or the hikes, sorry, I apologize. The hikes that are semi built in, and then you look out the curve. If for whatever reason the Fed did come in and hike, you're going to get stopped out of that trade. But then you can go out to the greens because that's going to lift that up. And in the long term, a hike into this type of situation would be very bad for the economy. And I do not think on any level they would do it. But if for whatever reason they got that, because all their own research says oil supply shocks are transitory, they just don't want to say the word transitory. They don't want to be caught up in that.
The question is, so oil up at $100, they'd be fucking nuts to hike. Just nuts. The tax on the economy of oil at that level will be, that's worth 50 basis points of hikes.
Right.
Roughly. So they don't need to hike. But you take oil back down and you get some animal spirits back in the economy. You get some, you get the consumer now doesn't have to just save to spend on regular stuff because oil is. The question then comes back to before all this happened, there was modest cuts. We were approaching neutral. If it all went away tomorrow, presumably that's where we'd still be, unless the economy has already gotten meaningfully damaged by the events of the last month, or this lasts longer and the economy gets really damaged. So in terms of the snapback, it makes me wonder whether, by the way, I agree with both of you that, there is opportunity in twos, for instance. You get it in any way you want. But it seems to me that you still have to actually have the war last for longer and the economy start suffering for that trade to really pay. I mean, it's cheap now, but for it to really pay off.
Yeah, but can it be argued as soon as you get Powell out of there? The uncertainty surrounding AI, the weak jobs. Our economy just took $100 billion hit from these high gas prices. And I'm saying even if like a resolution and we start rallying again,
there's no doubt.
Then it's the run it hot again.
There's no doubt Warsh can flip the narrative on a dime. The question is, can he bring the rest of the committee? And I think there's a reasonable school of thought that would say they're going to give him a honeymoon cut to do whatever he wants. Okay, you got to convince us, but the first hike's on us. We're not going to block you, right? The question is, can they go through 100 basis point cutting cycle, which would be this type of thing where real money can be made and stir? I'm not sure they can. I think they need the economy to legitimately weaken.
Yeah, but from these levels, even if they go 50 basis points, 2 cuts, and and say, hey, listen, we want a little clip here, and we're coming in. That's still a winner from these prices.
No doubt. No doubt.
Yeah.
And I think we're on the same side of the trade. I don't have any twos right now. I'm looking at them to buy them, but I'm just wondering on timing. How far is the positioning washed out yet? It sure feels like it.
I honestly feel like we have one more day of weakness in the curve with stocks going down, and then it's it. That will be it. There will be a disconnect, and all of a sudden the curve is going to say, fuck this. Look at the stock market, because now the stock market, we're under the 200 days. I think we're going lower. I think we're going to test deeper, and there's going to be a disconnect, and that's going to be the bottom in the stir curve. And it's probably going to happen early this week, because we'll probably get weak in equities early on in the week, little flush out under Friday's lows, and boom, there's going to be a disconnect, and they're going to flip, and that's going to be the low in the SOFR, and it's going to be 50 basis points higher from there.
I see that. Nick, follow up on that, and then let's go to long end.
Okay. I think the issue here is with timing, and when we talk about like the timing of this, I think like the curve is already presenting good value. So if you so it's like you have a good time to get in now. Could it go lower? Of course it could. But this is the shot to take. And if it goes lower, you take another shot, because the second that something happens in this environment and the right scenario comes, it's going to be one of those times where the trade runs away from you. And then it's going to be impossible to watch SOFR up 30 bips and you take that trade. Then maybe it's still the right trade, but it's going to be impossible for you to get in. So I think you could use options, which are going to be overpriced, but you can find some kind of option spread or something to do, or just buy it and just accept the fact that, hey, maybe I'm early, maybe I get stopped out, but I'm going to take another shot at this trade, and this is worth 2 or 3 shots in the book. To me, that's what I'm going to do. If I get stopped out of long SOFR here, I don't care. It's fine. I'll just do it again. And then, and I'm not gonna have limitless risk on. I'm gonna be pissed off when I get stopped out. But I think that the opportunity cost of missing this opportunity here is far greater than not taking a shot at all, and then having to chase prices higher. That would just be my thing.
Right. So for me, it's all about we can trade anything in the world. So
yeah.
I see a lot of things like that in this environment. You talked about baby with the bathwater. Yep. I think there are a lot of babies floating. And so the question is which one to pick up.
Yeah.
It might be the one, don't get me wrong. And maybe the right thing to do is pick up a lot of them. So let's talk about the long end. Let's talk about gold. I think Jimmy and I are on the same page in terms of an equity flush. I have normally I'm big macro, but right now I'm very focused on the month-end expirations as a driver for equity markets. So my macro view is pretty irrelevant. But let's talk about the back end. Let's talk about gold.
Gold did the typical thing it always does. People, for some reason, I don't know why, they think gold is a risk-off hedge, and it just has never been one. And it's often the number one place that people raise cash from to pay margin calls or to just buy dips in other assets that they like. You have this long-term allocation, and it's just sitting there protecting you against inflation. And in times of opportunity or in times of stress, that's where you go and you dump it. And so it seems to always catch people off guard when it crashes. But I mean, it's essentially, that's its design. That's its nature to do. And so would I be a gold buyer here? No, not really. But if you know me for long enough, I'm biased. I would much rather buy growth over an asset I have to pay to carry, but in my long-term allocations and my systematic models, they're all full of gold, and they have held it through the whole time, especially in the trend following world. So, I don't really know what to say about gold in this near term because gold's a long-term asset. So it makes total sense to me that it got dumped. But
Jimmy, what do you think?
I think it's not done with its retrace. I think we trade lower here. I think that technically we have solid areas from about 4250 and that up to 4400. We have a swath of area where I think that's where it kind of puts in the low. I think I would be 4250 bid here and patient and watching it. The metals across the board look like absolute shit. All of them, all of them. So there's not one or the other that are going to save one of them, and they're all reacting the same way.
The thing that I'm thinking about is both stocks, both gold and the long end. So the one thing is true is STIR has done what it's done. That's affected rate path. But there's also been essentially a deleveraging, whether it was caused by STIR markets deleveraging, which created a broader deleveraging, or the climate, or whatever it might be. There's a deleveraging going on, and people are raising cash. They are getting out of bonds, stocks, gold. To me, that is consistent with, what you want to measure that by saying, how much are risk premiums increasing? How much are real yields increasing? And the long end is really up against, particularly the 30-year, a little less so the 10-year. The 10-year real yield's about 2%. The 30-year real yield's about 2.75%. The 30-year real yield is pretty high relative to where it ever is. And I'll tell you, the one thing that you have to think about when owning assets is compounding at 2.75% for life with no inflation risk is pretty sweet. And so the question becomes to me on the long end is, do we get this? So do we break out above the 5-year, the post-COVID highs and settle? If so, there's going to be more trouble for gold, more trouble for stocks. If we come back, maybe there's a little rally in those things and you might have been able to miss them, but you have to break that. You have to then have a strong recovery in real yields lower. And I guess if I saw that, I might buy, but my sense is you can be patient. You can buy real yields at new highs or start accumulating over time as we break out to new highs, and throw a little bit of gold in because, gold, when real yields are high, the rock, which doesn't pay any yield, but has inflation protection in some sense, underperforms because you can get real yield from bonds. So I think that's my look is, so now the question is, independent of what's happening with gold, independent of what's happening with risk premiums, what do you guys think of the long end?
I on the chart, it looks like shit. Obviously, it really just kind of started. What's that?
There's just no support?
I have a little bit of support down, around 112, and then
ZB?
Yeah, and this is, but, the fact that we got underneath those SEP lows on Friday, the SEPO 25 lows, and that and now we're digging into that August area. I think yes, we're getting close to that, the bottom, you know what I mean? Like the lows of the 2025 lows. And then, we're getting into kind of scary situation. Where did we miss our bond buys by a tick? Was that 111 10s down in that area?
I think it was 110.16, but I might be wrong.
Okay.
I mean, that was we missed the lows for ZB.
And technically we're starting to get down into those rafters where we made low, the last 3 or 4 major lows in 2025 are on the bond charts. I think if you know, if
Low
we
was 110.25. We were at 23. If I
okay.
remember correctly.
All right. If stocks fall out of bed early in the week, I think that bonds, I think the entire curve will find a bottom here. You know, I think it's we're close enough technically to areas where, you know, and in that fashion, I think that, you know, 112 will probably be a low area in bonds and area you can dig into. If stocks aren't dumping and bonds are kind of nudging, you know, if stocks are like kind of like on Friday, stocks in the morning were, you know, buoyant, but bonds were just getting smoked. And then they, you know, if we're in that situation, then yeah, we could probably drift down to a 111.11, which is probably a lucky number too.
I have a big blue spot on my chart on that 111.11.
111.11.
A big blue buy.
Right. So you know a 111.12 will be the low. Okay. By the way, now that we're all like talking about it, that right there, that's kind of my line in the sand, the 111.11. You know, I think that's
I think if
I
you
think we
get there,
bottomed.
you might also see your 42.50 on gold. And then the question is it also
Right.
time
It's
is it
all going
also
to
time to
come.
buy a little stock?
Yeah. And then we have to go shopping for stock too. And shopping for stock is probably, you know, 6,300 S&Ps, somewhere in that vicinity, 23, a little above 23,000 in Nasdaq. We should flush down there. I mean that was a nice bounce on Friday off the lows, but that wasn't a, you know, that wasn't a low that
You mean
wasn't put in.
the 350 low, 350 p.m. low?
Yeah,
Yeah,
yeah.
I
I
mean
mean,
that
we
was
bounced off
that
some
was all,
areas.
that was all expiry and rebalance, and maybe even a leak of what Trump was going to put out.
And but you know, I mean, in reality, I mean, Jesus Christ, we were by the time we, you know, in the post, we were almost 70, is that right? 60, 70 handles off the low. That's not what you want when you have a market that's going down. You know, like is a bounce like that with no support, because we'll just yoke that shit and be right back down to the lows and making new lows in like that, which is going to probably happen tonight.
Okay, so that sounds like across the board buyers of dip of pretty much everything, but you need the dip.
But you need that, yeah, you need everything to make that final, whew, and they're all close to it.
But
Gold curve.
when it
Go
comes
ahead,
to
Nick.
the long end, you know, like I still think the front of the curve is presenting you a better opportunity for the current structure. And then when you but if we're talking about real yields, you know, if real yields get to 3%, like you buy them. You know, like you put a lot of money in them and then you go to the beach. So
Right.
you know, you take a few weeks off at 3% real. So that's just like a long-term allocation. If someone's going to give you
That's value.
yeah. If someone's going to give you 3% real, I don't care if it goes to 3.5%. You're good. You get the 3%, you're good. So that's like a long-term thing. But when we're talking about short-term trading, yeah, we need this flush. We need the flush in the bonds. We need the panic scare in stocks. And then, like you said, maybe gold at 4,200. You get that lining up, and then that's the time to take the shot. And I think it's important to focus when you talk about trading. Nothing is certain, but when they give you the shot, the game-winning shot, you have to take it. You have to take the shot, and maybe you miss, but it's okay, because then, you know, you get stopped out, you lose some money, and then you have better opportunities later. But if that happens, you take the shot across the board, and so that's why I had to.
And so here we are. So of course we got a plan, and now we get a headline, and stocks are up 1.5%. Bond yields are down 10 basis points. Stir is recovered to, I don't know, back to a slight easing. Are you supposed to chase?
I don't, obviously it damages the setup, right? Like, we want the big flush, we want the setup, we want the perfect shot, and if it comes early, now, you know, it makes things a lot more difficult. So, you know, essentially we're kind of hoping in a weird way for a little bit more chaos to kind of flush everything out. And if it doesn't, it definitely makes the trade a little more difficult. It's just, what is the headline, and like, what, and is there actually, is it provable? I guess that would be the
Chase
big.
the headline. The bottom line is, I think you chase if the headline is gonna have follow through. You
Yeah,
fade.
If it's from the Iranian side and it's positive, you chase.
Yeah.
If it's not from the Iranian side and it's just from our side, no matter how positive it is, you fade it. Fuck that. You fade it.
I think that's right, Jimmy.
I mean, come on. And this guy's full of shit. You fade this motherfucker. But if it does come from the Iranian side, if there's anything positive from them, watch out. Then we start running. I think the whole thing is going to end up with like VIX at around 30. That front VIX, April, VIX 29 and a half, 30. SPOOs washing out down maybe 6,300, maybe 28, 20. I'm sorry, maybe, like somewhere in that area. 23,000 NASDAQ. I think it's all like right there. 4,200 gold. Everything's kind of coming to that climactic moment. Even long end, 111.11. Like it's really like, and sometimes, there has been moments in my career where I literally look out at all the markets and I'm like, holy fuck, they're all going to do this all at the same time, aren't they? And this is one of those moments where it kind of seems like this could happen.
All right. I think that's great. So, Ben, do you have any more topics we want to cover?
Yeah, I wanted to cover the current state of hyperscalers and CapEx. This has been a through line for you, Andy, in the last two episodes. And I'm wondering, do you think instead of being compounders, they're turning more into capital intensive? And will that affect the price moving forward of companies like Amazon or Microsoft?
Yeah, I mean, the story is the same, I think. What I'll do is I'll add a little bit to that story. The big story is we've got $1 trillion of CapEx that it needs to get funded. It's going to get funded by less share repurchase, more corporate debt, IPOs by private companies who will then reinvest the proceeds in chips. And those are a lot of promises that need to get funded. Now you also are adding, and by the way, that was in an environment where you already had 6% of GDP deficits. Tariffs have gone away. The tariff revenues are going to be lower unless he does something about it. He may not, but that's going to be a deficit increaser. We've got $200 billion of additional U.S. deficit for rebuilding and enhancing our war effort. We've got real countries who make all their money by selling and transporting oil that aren't making any money, and they are accruing, are unable to spend on what they spend their money on. They always spend their money on the proceeds they get from oil on their citizenry, and they don't have the money, so they're going to have to borrow. You've got rebuilding of anything that's gotten damaged. Each of these things has escalated the demand for savers to pony up money to fund growth. And so while I don't think the hyperscaler thing is changed at all, I think the outlook for them is the same as it's been the last couple of months. There's more people asking for money than ever before, and it's escalating. And so that to me, so what does that mean? That to me means prices of money are going to rise, tightness of money is going to rise, which means people are going to say, well, do I actually need to do this borrowing because it's more expensive? Mortgage rates have already rallied to higher than they were January 1st, even though the Fannie Mae and Freddie Mac have bought $200 billion of mortgages. So homeowners are getting tight. And that has a negative impact on growth. And why I think we're all bullish on STIR and we're looking to buy bonds and suspicious on stocks. That all is playing through. But it's not a great environment for assets, actually. When everybody wants to sell assets. That's just not the greatest environment. So that overhang to me, listen, we're going to get a huge rally on an Iranian-driven de-escalation, no doubt about it. But after that, I'm not sure where I'd be, given the overhang that I just described. So that's my picture on that.
I think there'll just be a divergence in the stocks. So essentially, Microsoft almost down 35% has somewhat covered that. You know what I mean? Like that value has been erased. And so now when you're buying it, you're not buying the previous lofty projections of it. So some of the damage in these stocks has already happened. It's happened beforehand, and the lack of buybacks. All these things have been priced into it somewhat. And I think you're going to have, sort of with the AI, it's going to be, you're going to have those companies that are going to be fine, like a Microsoft or an Amazon. Amazon had the biggest revenue it's ever had. I think of a company in general. Like you're talking about massive companies. The ones that are going to be hurt are the small players. The small players that these guys can replace easy with a guy that can code and use Claude at the same time or whatever, right? Like those smaller players are actually going to get wiped out pretty easily. But when it comes to the big ones, as long as they've went through this corrective phase, right? So they're not near the highs. Like a Microsoft is down. Amazon's not down as much, but down 15%. I think I haven't looked at the chart really, or the percent, 20%, 20.
All the hyperscalers are down.
Yeah.
By the way, I agree on that point, which is if the hyperscalers actually do rally, other stocks are going to get fucked.
Yeah. And so, but if the big boys can rally, that's going to keep stocks somewhat floated up. You know what I mean? And these ancillary players, the small guys, they're not that important in the grand scheme of the stock market as a whole.
Macro doesn't matter.
Yeah,
but I
yeah.
thought you were moving to rotation.
Yeah.
Jimmy, you mentioned the NVIDIA and XLK.
Yeah. Those were kind of my harbingers that I was kind of, everything, like as long as they're held the line in their 200 days, we had a shot at maybe, pulling our way out of this, but they really lost that on Friday. They both got crushed and traded like shit. And NVIDIA trading like shit right now, especially with like the circular
They're killing it. From an earnings standpoint, just absolutely killing it. Micron, all the semis.
But they're all trading like shit.
Badly.
They're trading terribly. And not only terribly, they're breaking parts. They're breaking like their charts as we're talking. You know what I mean? Like they're not only trading poorly, but they're forecasting lower prices. So I think we're on our way to a dip here. And I think there's terrific places to buy this dip. And I think there's many reasons to buy this dip, but we're on our, here we go. Here, we got a little bit ahead of ourselves. And I think a lot of it is because of what you just outlined. These guys have to borrow a lot of money to make all these dreams come to fruition, and meanwhile, the governments are borrowing money. The Middle East is like,
and they have a lot of the promises. They've reiterated their promises, but damn, they're not going to get it unless they can sell their oil.
I got to ask you one question. Do you think that it might be mildly bullish Bitcoin because of the populace in the Middle East being as wealthy as they are? And this is like what it was originally designed for, put your net worth on a flash drive and get the fuck out of there, right? You don't have to, load your car up with gold.
I'm long Bitcoin now I'm underwater again. It seems I never can get above water for any period of time.
It's dancing on that assets suck, but this might be what originally intended for.
I got to tell you, the big mystery to me, and again, this is not our space broadly, but certainly not mine. These BTC treasury companies issuing preferred stocks, warrants, financing whatever they possibly can, constantly selling to buy Bitcoin.
Mm-hmm.
Who the fuck is selling this shit?
Yeah.
Where's it coming from? And I don't have a good answer for that, and that worries me.
Yeah.
Like, to get bullish, I'd like to see buyers actually cause the price go up.
Yeah. Yeah, I think BTC goes out of this bear market when one of these big yield farmers or whatever the hell you want to call them actually struggles and blows up. It doesn't have to be MSTR, but there has to be some FTX level drama to wash this sickness out of the space and then boost it back up. I guess I think like we're pretty much near like an hour mark here, but the last thing that I personally wanted to ask is, what do you guys think about the Europe trade now, like sort of the Europe versus the US, and with the different oil dynamics and the rotation out of the dollar, kind of that get out trade, yeah, that seems to be ending, or at least, it's time to take profits on that. So what do you guys think about that?
Yeah, so I did. I've been on that trade for 15 months now since the inauguration, not because of Trump, but because of his policies, and which were improve the conditions for assets globally at the expense of U.S. performance. And that worked out beautifully, plus the long end of the Japanese and European yield curves offering balance. All that's true. And I think it played out. Now, that doesn't mean that we're somehow the secular story of massive overweight globally of U.S. assets is over. I think that's secular, and you're going to continue to see weaker dollar than you might expect and stronger relative performance of non-rest of world stocks versus the U.S. But in a world in which oil is much more of the literal and figurative grease of the non-U.S. economy. Japan can't live without it and doesn't have any. Europe can't live without it and doesn't have any. And that's pretty bearish for European and Japanese growth outlook. And so it's not surprising to me you're getting some reversal in that. But to me, I think we're at a point where it's more of a story of global balance than it is a big lean either way.
Yeah, makes sense. And then do you have any view on the yen? Because it would be a great place to be, but like if the dollar gets a little stronger, it's going to be difficult, But maybe on a rebound here, a positive war thing, the dollar goes down, you could take a shot at the yen or something like that. But
yeah, I don't have a trade to do today on the yen. I don't think the so-called 160 line in the sand is going to be enforced. So if you're an aggressive trader and you imagine that the market's going to challenge the BOJ to intervene, the MOF to intervene at 160 to support the yen, I think you can press through that. So yeah. Gun to my head, I'd say you test 160 and it fails, then you get to 62 or 63 or something like that. That might be a good time to buy the yen.
Yeah. I agree with that.
Let's end it with tariffs. The tariffs are currently in place.
That's the 150? Yeah.
Until July. And then there's already legal challenges. How do you think that will affect the economy going forward?
Right. So the question about tariffs is, listen, we've got midterms coming. There's very little chance that a tax legislation, particularly when you're already asking for a couple $100 billion in new financing for war, that you're going to get a tax cut. You're just not going to get that. And so the question is, what does the Trump administration want to do to boost the economy? The easy switch, they could just flip it, is just not execute on the replacement tariffs. Let the 150 days expire. Well, I think it's June, but whatever it is. Let that expire and don't reinstitute. And that gives you your consumer tax cut. So on the other hand, it's really shitty for bonds because that's just another couple $100 billion a year that you're going to need to issue debt to fund. So to me, it's a lever. I don't think he pulls it. I think he really likes tariffs, and I think he really likes the revenue, and I think feels like he's gotten screwed by the the courts, and he's Mr. Tariff Man. So I think he goes and does all the tariffs that are expected, and maybe surprises on the upside, which is bad for growth and good for bonds. But that's a lever, and if he decides to pull that lever to stimulate equities and stimulate growth, and you just short the shit out of bonds the moment he does.
I don't think he ever abandons that, by the way. I'm with you. I think he loves tariffs. I think he loves that revenue. And I think it's merit based. I think I don't think he ever abandons that.
Yeah, I think one of the mistakes that people make when they think about Trump is things like this midterm coming up. Like he's gonna try his hardest to save the Republican Party, or to try like I would assume that there's smart people around him that say, number one, the odds are against that he wins anyways. There's like in the midterm, like he's gonna lose. So it's like historically the president loses this anyways. So you add on top of it, you're not doing things that are very popular. So he probably, to me, he's going to be like, I don't care what the Republican Party do. I'm going to do what I want to. This is my last hurrah here. And I'm going to solve some wars. I'm going to put some tariffs on. I'm going to do it my way. And I'm going to show everybody that this is the case. And so whether you agree with that or not, I think it's a very big misstep to assume that Trump gives single crap about the organization of Congress and his
I'll tell you, Nick, I've agreed with you from the get-go on this exact topic, but that is not consensus. People think he's going to pump.
Yeah, it could happen, but I really think that he's abandoned that principle, and I think this Iran thing kind of shows you that, because like it's like he's like, I'm gonna go out and I really think that I'm doing the right thing, whether you agree with that or not. I think that's what he thinks. I think he thinks tariffs are the right thing. I think he thinks he's bringing about some kind of global order, and I think he's going to stick to that. And if you look at how he treats other Republicans, at times he'll throw any Republican under the bus. And quite frankly, I don't think he really has a party. He's more of kind of his own Lone Ranger, and that's how he wants to go out.
I agree with you.
Yeah,
that's a good way to end it.
Me too. Awesome.
All right.
All right. Thank you for watching. Bye.
Have a good
Thank you,
one.
everybody.